Nigeria's sovereign risk premium surged in an 8-month high, and its dollar bonds were some of the worst performing emerging market assets of late, amid concerns that cost of living protests across the country would derail the government's economic reform plan. On the other hand, the stock market recorded mixed performance as the Nigerian Exchange Limited depreciated on Thursday, the first day of the protest, and appreciated on the second day. Now, the past week's unrest comes soon after violent protests had forced another African nation, talking about Kenya, to scrap crucial measures introduced to raise budget revenue, and some investors have been disturbed about Nigeria's situation, and rolling back the future is dicey. This morning, Muktar Mohammed, CEO, Asia Investment Limited, joins me for this conversation. Thank you so much, Muktar, for joining us on the show.
Thank you for having me.
Let's start by first quantifying the loss of the Nigerian economy, looking at the disruptions that we've seen in businesses and the protest that has gone on. We just had a reporter talk about what happened in Abuja, and we see that it seems that business is beginning to pick up. But then what do you make of all that has happened in the last 4 days?
Well, thank you again. And if you look at the Nigerian economy, it's largely driven by the informal sector, and they are the most vibrant sector of the economy, especially the transportation, the petty traders in the market, and that sector alone gives Nigeria economy over 200 billion, approximately 200 billion, over 200 billion, but let's just say approximately 200 billion. Then you all know that most of Nigerians also live by daily income. Even some places that you think are informal, or some places that you think are formal, like the filling stations, they also live by daily income. Also, even the Nigerian stock exchange also live by daily income, because you need to attract investors to come in and buy equity, and then they make their money for that day also as commissions. So when you look at this, you're thinking of an economy that lost almost $300 billion dollars almost 300 billion naira. So you're looking at maybe between 600 to 700 billion. I could just say approximately 700 billion, because you're looking at 2 days of full compliance, then you're looking at the other days of half compliance. And even if you say businesses have coming out gradually, if you look like a state like Lagos, I went out partially this morning. It's still a matter of caution from a lot of people. A lot of people are not going out there, and some formal companies are telling their employees to work from home. So definitely the Nigerian economy is the one to lose. And like I said, the vibrant SME sectors are the one that are worst affected.
And that would mean that the demonstrations actually hit Nigeria from all sides economically. Let's talk about the sovereign risk premium that I mentioned earlier in my introduction, because we need to understand even the various factors that usually contribute to that sort of calculation. So let's have an understanding of what it means, and before we now look at the Nigerian context.
Well, what normally happens in that sort of, what you look at, that is a two-way exchange system. Coming in and going out. Once you're coming in and going out is a problem, then it also becomes investors become scared and trying to dump up your sovereign wealth bond. Because what I mean by coming in, I can come in, invest, and exit at any time. We've had those challenges now. Then the stability of the exchange rate also determined, because you don't want to come in at 1,500 and then you are exiting at 1,800. So you want stability. Some of these bonds, when the investors bought them, I think they entered about 360. So now they are exiting at about 1,500. So that's also a challenge for them. So they want to go in and then come out, and then they want to be able to make profit also. That's the second one. And then security also is a problem when you look at some of these bonds that were issues again for government infrastructural development, most of them. So those are what investors looked at. And when you look at our economy at this moment, we are really suffering from some of these things. Unstable exchange rate, because of today is 1.5, tomorrow is 1.6. Insecurity is still there, even if it's not prevalent in one of the biggest Nigerian economy in terms of state, that is Lagos and Abuja. But we still see pocket of insecurities. Then the two-way exchange system is not there. They are not easily, they've not been easy for them to exit the market. So that for me is a big challenge to them.
And obviously, well, the surge in Nigeria's sovereign risk premium is actually suggesting that investors perceive some sort of risk in investing in Nigeria's government debt. So let's look at how that affects Nigeria now with this, perceived risk as we see it on the part of Nigeria and the predisposition of the investors.
Well, you should also not forget that we've not been brought back into the emerging market index. So that's a problem. That's where investors go to look at which market they want to invest in. We are out of that market since the Buhari administration. Up to this moment, we are still out of the market. And that's why you see that we just have an investment of about $500 million, what the president was saying in his broadcast. So a lot of investors are still not excited to come into Nigeria, especially because of those exchange rate. And like I said, we are not listed in the emerging market index. So definitely that also is making us not to attract a lot of investment. But basically, what make you to be listed there? What are those policies that you have to come in? You have to have a two-way exchange system, which is very key. In an exit that is not there. You talked about the risks that have just been involved when it has to do with instability in the exchange rate. That is still there. Then coupled with government microeconomic policies that have not been able to impact positively on the life of the people or the companies that are in Nigeria. So those are some of the factors that makes our sovereign wealth very high risk. So what you see is that most investors that actually come into Nigeria come in here because of they are ready to take the risks, believing in our economy, which is good, but you just realize that they come in trickles compared to when we have them come in so many.
And that would probably mirror what we are also seeing in the Nigerian bourse, because the Nigerian stock market showed mixed reactions during the recent protests, with a depreciation on the first day and an appreciation on the second day. So then would you say that it is still the same factors that actually influence this mixed performance? And how do you think the short-term events would typically impact the stock market behavior in such an emerging market?
Well, for Nigeria, I think the protests didn't have so much effect. We have to, especially in the Nigerian Stock Exchange, because traders, stockbrokers, traders were able to trade from the comfort of their room because of the advance of technology. So that sector was not totally shut down. Then what has been happening in that sector is been a while that has been ongoing, especially because of the bank recapitalization, and a lot of retail investors are not able to take their right or even be involved in the offer because of the price and the earning ability. So we've seen those slow space, especially because of the banking recapitalization. Most investors that were interested in the banking stocks are no more interested because of the CBN policy of taxing their windfall. So that will maybe bring down their earning per share. But investors were already looking at those space, and they were laid back about even investing in the market. And then when you look at other conglomerate like MTN, like Dangote Sugar, Nigerian Brewery, International Brewery, they also did not help investors have so confident because of their result came out and it was negative, and all due to government policy, especially the exchange rate volatility. Wow. So that's what is responsible for the kind of activities you are seeing in the Nigerian bonds. But again, the second day you saw those recovery were due to the little gain that we saw happen, especially the banking stock. There was gradual recovery. Some of those banking stock are selling lower than their right level, lower than their offer level. But we saw a gradual return in terms of price movement in those equities, especially the banking stock. That's why you saw the recovery that you saw on the second day of the riot. Of the second day of the protest.
Okay. Let's now talk about the dollar bonds. We've mentioned the Nigerian bonds. Let's describe, looking at how it has worst performed in terms of the emerging markets. Let's look at the issues around that and also see if there is a way to improve that indices.
Well, for the dollar bond, like I said, the main issues behind the dollar bond has to do with liquidity. And when I talk about liquidity, we're talking about a two-way liquidity system, and that's been the challenge. And secondly, exchange rate volatility. But you can merge exchange rate volatility and the liquidity issue because, again, what is leading to volatility is lack of liquidity. So is the major challenges they're having. But I think there might be a little bit of a gradual recovery anytime soon, especially with the FX reserve growing to about 37, $36 billion. So that could give investors confidence to say, okay, when it's time for payment of these bonds, the government will be able to pay. But again, the challenge there also is like policy somersault also from government. You saw what happened with the banking recapitalization. You cannot use your retail earnings. You have to look for fresh funds. In the mix of that, you come in with a capital FX, capital gain, windfall tax. So that does not give investors confidence. I mean, they don't know what you come up again with tomorrow. So I think basically it has to do with liquidity, it has to do with volatility, and then it has to do with monetary policy decisions because these are monetary policy decisions when you said, okay, you don't have to get into your retained earning to boost your capital base, and then the physical side that came with the tax windfall on fact with FX, tax on FX windfall on the bank. So those are part of what makes those Nigerian dollar bond not attractive for investors.
Okay, so we also understand that city strategists are looking at the fact that there's possibility that this protest, whether or not it will continue, will not escalate like we had in Kenya, probably maintaining a middle weight on the Nigerian bonds. Do you also see that way in terms of Nigerian bonds and yield curve?
Yeah, there will be a call. Even if we are not excited with what the president said during the broadcast, a lot of people will look at some of those policies and say they are good policies. But again, implementation has been the challenge. And hopefully, with the coming days, they could begin to see some light at the end of the tunnel, especially in implementation of those policies. You see, what you will see is that during the broadcast, the president seems not to shift ground on his policies. He seems to say that this is the right policy and I'm going to continue with it. So that also will give investors confidence compared to the Kenya or whereby some of those policies were suspended. That also will give international investors a little bit of confident to want to come into the market. To say between Nigeria and Kenya, whether it will be like that, like I said, after that broadcast, you've seen a slowdown in terms of events of demonstration. Even if those slowdowns is not that people are exactly excited about what the government have done. I think most people are just saying this government doesn't listen. So if we do from now till tomorrow, they will still continue like that. So that also, and then with security agents everywhere. So investors will look at that as part of keeping the state peaceful for investment and said, okay, be able to cope with the challenges of the protest. And like you know, Nigerian protest is largely driven by hunger, and the government have rolled out some policies. And so investors sometimes look at policy in the short and in the long term. From what the president said, he has come out to give us short-term policy that he will be doing and long-term policy that the result of his that will be from the result of some of his policies. Even if a lot of us have doubted what of this, it was more or less like a campaign speech telling us this is what I'm doing, this is what I'm doing. So it was more or less like these things are on ground. You talk about the CMG buses that are supposed to reduce cost of transportation, they are not yet down. You talked about the 1,000 free CNG that the president mentioned. There's not any, especially in Lagos. Maybe there in some other place. You talk about what the president said, 68% of 68% that transportation costs have come back by 68%. Then you begin to ask yourself whether the president do read what the National Bureau of Statistics are pulling out there in their monthly report. So. But again, like I said, in investment, they want to see most of those investors came in because of they believe in this administration and the policies, and they seems to say, okay, this president still want to stay with this policy. That could be the tipping point for that for us to see a resurgence of the Nigerian bond. And like I say, the foreign reserve have also grown considerably compared to when they came in. So that also will add. Oil production seems be going high. According to the president, he said we'll be doing almost 1.6 million. Remember that sometime when these investors even invested in this bond, oil production was almost 900,000 to 800,000. So they will see all those figures that are coming in, and they will be excited about it. That could look for a tip. So I think the major game changer is the fact that the security agents were able to cope with the protest. The government stand rigid on their policies, and then you see the CBN saying that we have grown the foreign reserve, and that means there will be liquidity to pay off this Eurobond when it is time for them to exit.
Okay, so before I let you go, Muktar, some economists have actually blamed the IMF and the World Bank for these kind of situations that we've seen in the African countries, because most time they table conditions when countries come to them for loans and for restructuring talks. But then in Argentina and Ghana, it seems to have worked out for them. Kenya and Nigeria are not so good. What are the differences? Just in about a minute.
Oh, well, the differences has to do with government. If you look at Argentina and Ghana, it was processed. It was not a one-off removal. When you talk about subsidy for electricity in Ghana, they gave them time. You talk about Argentina, it wasn't just a one-off policy. But when you look at Kenya and Nigeria, it was thrown to them like to be a one-off, remove subsidy now, your economy will be fine. And so they gave them gradual time. They looked at the years. The same thing is happening in Egypt. Even if you are not mentioning they are removing subsidy, they are going to remove subsidy for the next 4 years. They have that plan with the IMF. And some of them also decided that there must be an injection of liquidity into their economy first before they begin to implement these policies. But in the case of Nigeria, the promise of injection of liquidity has not been there yet. And so that put more pressure on the people, especially in an import-dependent economy like ours. So I think that is the difference, where you see those results there. But those results didn't just come up where subsidy was removed one-off. It was a gradual removal of those subsidies compared to what they want to happen in Nigeria and Kenya. And in Kenya's way, they've been a retreat, but in Nigeria, the president is still rigid. But how long can he continue to be rigid? Because like I always say, the IMF is not in Damaturu, the IMF is not in Potinsco, the IMF is not in Ecom in Cross River State. So Nigeria economy is largely driven by the vibrant informal sector. And most of these IMF policies are for the formal sectors. And when you have an economy that is largely driven by the informal sector, the policy seems not to add up.
Okay. Muktar Mohammed, CEO of Share Investment Limited, thank you so much for your time.
My pleasure always. Thank you.